Okay, making sure you guys can hear me okay. All right. So, thank you first of all for having me here. I appreciate it. It's a pleasure being here. These are critical topics and super important information. So, it's my pleasure being here and being able to contribute. First of all, let me just give you a brief rundown about my story, who I am, so you get a feel for who's talking to you. I was a teacher for 7 years back in the 1990s. I taught middle school, did a lot of coaching basketball and all that stuff as well. I was introduced to investing, specifically in annuities and the whole idea of compound interest at the age of about 24, 25 years old. Part of my story is that by age 30, I had a negative net loss to my name. I had $10,000 from my teacher pension 5 or 6 years, 6 years later, but I owed 15,000 on my car. I owed 25,000 in student loans, and I had a net loss to my name. Had never lived in a house owned by anybody I knew. Grew up in apartments, but something transformed in me at age 30. I got married, started going to church, gave my life to Christ, started learning and understanding about giving, started looking seriously into real estate, and ended up by the end of the year 30, buying my first house and buying my first rental house also. So fast forward 20 years later, I have a net worth that's approaching seven figures. And when I say approaching, I mean way up there. I don't say that to brag or do anything else or put myself above others. I just say it to say, if I can get focused from where I come from, then anybody can get focused and do it. It takes some time, it takes some patience, but you can do it. For my day job, so you know about what I do in the daytime, I do have a job. For the last 14 years, I've been a contracting officer for the federal government, managing contracts on behalf of the federal government. I also, on the side, help individuals manage their money, grow their real estate, and manage their real estate. I do free 15-minute phone consultations. But you can get more information at the website, and I think they'll give that to you later, smartmoneybro.com. So how did I do that? How did I become or get to where I am? It's no miracle. I didn't win a lottery. I didn't do anything fancy. I just did really basic things with money. And part of that was investing in my job's retirement, investing in my job's thrift savings plan as a federal government employee, invested in side gigs. I had an eBay store for 6 or 7 years, still have it, but I don't do much on it. But it helped pay my daughter's way through college. So she graduated college with no debt. And I also do voiceovers on the side. And I've had a ton of side jobs. But I invested in my learning. I set some goals, believed in myself, and I gave and helped other people along the way. So personal finance is personal. That's the first thing I want to just kind of say to you guys that, some of these absolutes that we say depend on some situations, right? Your age, your job type, your income, your living situation, what are your goals in life and so forth. So much of the things that we talk about in terms of all the things I think we've talked about, and at least investing, is that these are personal choices that you have to decide and make based on your situation. So let me just kind of run through, and I guess I say next on the slide. Is that how I do it? But I think the slide I might be a little different than what's on the slides. I'm not sure. So if you can go to the next slide, is there a next slide? I think you had it up with some points I wanted to make. So let's jump into it. Okay, so, and I'm going to kind of jump around these bullets. But the first rule, I'm going to give you some rules of investing that you guys need to think about. First rule is that investing doesn't have to be complicated. It doesn't have to be anything that's rocket science or really high level stuff. I recommend you always invest in things that you understand and that you are comfortable with. So don't get caught up investing in things that are the fad or the latest thing that looks shiny, because a lot of times those things come and they go. If it confuses you or you don't quite understand how it works, never consider investing in it. I'm not saying never, ever. I'm just saying not until you understand it. For example, cryptocurrency is a big thing nowadays. I wouldn't suggest you invest any money in cryptocurrency until you understand what you're investing in. If it's a specific Bitcoin, Ethereum, whatever it is, please make sure you understand it, study it and research it, learn it, understand the risk, the liquidity, all that stuff before you invest in it. Same idea for real estate. Same idea for stocks, for mutual funds, for ETFs. And we'll talk briefly about some of those things coming up. Rule number 2, if your job has a 401k, go ahead and start investing in that as soon as possible. Walk into your HR office, invest a portion of your check in it every single month up to the match. Most jobs match, some don't. I understand that. But try to invest that money as much as quick as possible and just get that match. This is first and foremost. That's free money. You don't want to lose it. Now, again, do your research and understand all of the options that you have to invest in underneath that 401k program at your job. Again, you're learning and understanding what you're investing in it was the first rule. So, but secondly, go ahead and invest in that immediately if you can. And then if you ever leave that job, make sure that you have that money transferred to a new job. Because I know most of us are not entrepreneurs. Most of us have jobs. So I want to kind of put that disclaimer up high on the rules because people just leave that free money on the table and you don't want to do that. Again, when you leave that job, all that money that you accumulated there, you can have transferred. And I put that in quotes because you don't want to see that money. Because if you have that money sent to you from your old job, you pay taxes and penalties on that money. So you just want to have it transferred. Let me give you a little bit of this. When that $10,000 I said that I had when I left teaching 21 years ago, I just had that money moved over to the federal government. And when I had it moved to the federal government, it's still growing to this day. So, that's another part of it. Things take a while and there's patience that you gotta employ as well. So don't get a loan on the money in terms of what you have in terms of 401k if you can help it. And don't borrow from it if you can help it, because compound interest happens over a long period of time. But anyway, rule number 3, get your financial household in order before you invest. And I say that other than the only exception is obviously your match in your 401k at your job if you have one. When I say get your financial house in order, I'm saying budget. Budget means be organized. Budget means you understand what's coming in and you understand what's going out every single 2 weeks or every single month. There's a certain amount of empowerment that comes from budgeting. I know sometimes budgeting gets a raw deal out here amongst people. Well, I don't budget. Well, budgeting gives you empowerment over your money, right? You want to be empowered. You want to have some control. And by sitting there and not writing down, or you can do a spreadsheet, what you bring in, what you take out, you're going to feel better about yourself and your money if you take control of it. Make sure you have some emergency money together before you invest. What good is $50,000 sitting in a mutual fund somewhere when your washer and dryer goes out? What good is $20,000 sitting around somewhere invested in AT&T when you have an emergency, your tires go out on your car? So you want to have some of those things taken care of before you get to the investments. Again, all of this is other than your 401k match at your job. Be sure you read and you take in presentations like this as much as possible. Go to the conferences, get the new books, whatever it takes. Set some goals for yourself. Deal with your debt. I didn't say necessarily pay off all your debt, but I said deal with it. Have it in front of you. Have a goal, a plan in place to reduce it and eliminate it as much as possible. Once you do all that, this is rule number 3, get your financial house in order. Then you can turn around and say, let me go ahead and plow some money into investments. But again, what good is investments if you haven't got some of these other things taken care of? Rule number 4, know your tolerance for risk as you start to invest. Some of this will have to do with, again, your age. The younger you are, the more time you have, and the more you can be a little more risky with your investments. But know who you are. Me personally, I don't have a high risk tolerance, right? So I don't have a whole bunch of things like cryptocurrency and stuff like that. I like really safe investments. That's the type of person I am. You need to know who you are in terms of how you can handle and not handle risk before you consider jumping into serious investments. Rule number 5, understand some basic terms like compound interest. And compound interest is just interest upon the principal. And then appreciating assets versus depreciating assets. So appreciating assets are things that obviously are going up in value. They're appreciating in value, real estate, stocks, commodities. Depreciating assets are things that are going down in value. Clothes, concert tickets, cars, those type of things. As soon as you buy them, they lose value. So understand some of those basic terms, and that's going to mean you got to do a little bit of reading about investments and investing. Don't just expect these things to come naturally to you. You have to actually put in some work to actually learn about them. Rule number 6, types of investments. There's a number of different types of investments, and we don't have time to go through all of them. 4 basic ones, or a couple of basic ones, are 401ks and 403bs, right? 401ks are offered through a job, through an employer, and 403bs are offered through an employer, but typically for a nonprofit, school districts or things like that, nonprofit organizations. So those are offered through employers. Then you have IRAs and you have Roth IRAs. Individual retirement accounts is what IRA stands for. And Roth IRAs. And they're just handled. IRAs are dollars that are invested into a retirement account that you will pay taxes on later when you withdraw it from that account. The Roth option from the senator, I forgot his first name, his last name was Roth in the 1980s, but senator from Massachusetts. The Roth IRA is just like an IRA, except that you pay taxes on it now, and then you contribute to it with after-tax dollars. And so when you pull out the money and withdraw the money from a Roth, obviously you've already paid taxes on it, and you don't have to pay taxes on it at that time. So they're gonna get the taxes one way or the other, either before you invested or after you invested. And then there's limits to those contributions that the government has set up for 401ks, 403bs, IRAs, and Roth IRAs. There's others, 457bs and some SEPs and things for people that don't have a job, and maybe they're entrepreneurs. So there's other things that are set up for you in terms of types of investments. Number 7, or rule number 7, or information number 7, is where to invest. Lots of different places to invest your money. Everywhere from, there's things like savings accounts and CDs. I don't necessarily call those investments because the return is very low in terms of percentages that you get from those. Even high yield savings accounts don't offer very much return on your money. Then there's things like money market accounts. There's bonds these are all things that offer low return on investments. They're very safe investments. And when I say bonds, there's corporate bonds, there's government bonds, there's municipal bonds, and bonds are simply an IOU from whoever issued the bond to you. If I purchase a bond for $100 and it has a maturity date and it has some interest tied to it, that means that at a certain date, whoever I purchase it from is going to redeem that bond, give me back that money with a little interest on top of it. Not a real popular thing because stocks have been doing so well. And when stocks do well, bonds don't do well. When stocks start to crash and go bad, bonds do a little bit better because people are shifting their money from stocks over to bonds. So I don't want to go too deep into that, just to say that there's also index funds and there's mutual funds. There's ETFs. Those are the different different places where you can actually invest your money. Index funds, meaning it follows an index, not managed by a fund manager. Mutual funds are a group of individual stocks that are managed by a fund manager. And so typically the fees on the mutual funds are higher than they are on index funds because mutual funds have to pay the people who manage them. And so you'll see higher fees on mutual funds. And then ETFs, there's also real estate in terms of where to invest your money. And again, there's things like that are kind of new on the scene, cryptocurrencies and so forth. And then there's different types of stocks. And I don't want to get too deep in that. There's growth stocks, there's speculative stocks, there's dividend producing stocks. that pay dividends on a regular basis for a year. Like AT&T is a great dividend stock. There's blue chip stocks that are really established companies that are very old, Procter and Gamble, Disney, etc. So I say all that to say these are things that you need to learn, you need to research. Now, I am not a person that likes investing in individual stocks because again, my risk tolerance is very low. I don't like really risky individual stocks. If you do like investing in individual stocks, then you might want to make sure you have 50 or 75 or 100 of them so that you're diversified and you're not, all your money is not one place, so that when that one stock crashes, now you're out of $100,000. You want to be spread way out amongst a lot of things. I personally like index funds the best, but that's my own rule. Rule number 8: how much should you invest? I always tell people to figure out what your goals are and then sort of reverse engineer how much you want to invest. So if you sit down and you create your goals, again, you're doing your goals and things before you even jump into investing. Back to the other rule where you're doing budget, your goals, and what you want from money, what you want from investments. When you do that, figure out what you want, and then you can kind of reverse engineer it. Okay, if I want to have $1.5 million by the time I'm 60, what do I have to do at age 40 to get there? Okay, I have to do this, etc. So the one thing I want to say is make sure that when you do invest, when you're committed to it, you make sure that you invest, you don't just invest a tiny little bit, like 1 or 2%. Of course, 1 or 2% is better than nothing. But try to push yourself to a little bit when you invest. Because pushing yourself, again, increases risk, but more risk, more reward in the end. The ninth thing is I want to talk about is just simply set it and forget it when it comes to, unless you're the type of person that loves investing, loves looking at the stock market every day, just set it on autopilot. Do it automatically from if you get a paycheck, or you can do it automatically from your checking account or savings account. That way it's no hassle. You simply would open up a brokerage account with, say, TD Ameritrade, Fidelity, Vanguard is one of my favorites. They invented the index fund. Vanguard did in the 1970s. Open yourself up a brokerage account. It's just like opening a checking account. You have to tie your checking account to the brokerage account, but then the brokerage account can pull $50 every 2 weeks from your checking account. They can pull $100 once a month. It can pull $300 once a month. If you can, use that type of brokerage account to make this thing automatic for you. And then keep in mind, finally, when you see the stock market crashing in the next 6 months and you're invested in the stock market, don't panic. Keep putting your money in there. 6 quick things. Don't invest too little. Don't sit on the sidelines and not invest. Number 3, only invest in things that you understand. Number 4, try to get a return on your investment that's greater than inflation. If inflation is 4%, you don't want to have a return on whatever you invest in of 3%. Then you're essentially losing money. You want to try to invest more than what inflation is, and that means you want to get 5, 6, 8, 10%, 12%. Invest your money. Number 5, invest your money, but also invest your time, invest your resources, invest in your relationships, invest in your future self, invest in your self-improvement. Read the seminars, the YouTube videos, etc., as much as you can. So it's not just investing money, it's investing in yourself to get there. And then finally, have your household finances in order and under control, and then invest your money. The only exception is, of course, your match at your 401k at your job. Do that immediately because it's free money. So that's my presentation. I'm happy to answer questions. You can always reach out to me. I give 15-minute free phone conversations because, again, personal finance is personal and everybody's situation is a little bit different, and I understand that.